Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. We've got an hour left to go in the trading day, and we are seeing green arrows across the board right now. The Dow up more than 200 points as it looks to end on a positive note for the first time in 7 sessions. The S&P 500 up 49 and the Nasdaq up 218. In terms of sectors we're watching today, tech regaining its footing. The sector up about 2% today on the back of some big gains, led by Meta. Shauna?
All right, well, it is the final trading trading week, the first half of the year, and it certainly has been a whirlwind for investors. Fed policy has been front and center. Aggressive moves from the central bank. It kept the market on edge, with Wall Street trying to guess what the Fed is going to do next. And stress in the regional banking sector, well, that added to market jitters. 3 banks failed, prompting concerns about a widespread crisis. And that's not all. The debt ceiling drama down in D.C. was another big risk that investors had to manage. But through it all, a recession has yet to materialize. In fact, the AI frenzy fueled massive gains in tech. The Nasdaq on pace for its best start to the year that we've seen in about 4 decades. Here to parse through what all this means for the second half of the year, we want to bring in David Lebovitz. He's JP Morgan Asset Management Market Insights Managing Director. David, it's great to see you. So certainly investors had their fair share of news and headlines to digest during the first 6 months. How does this set us up for the second half of the year? What should we expect?
So I think that there are a couple of things that investors are going to be focusing on in the second half. Obviously, inflation and Fed policy are very much at the forefront of their considerations. But I think lingering in the background today, and something that will really come to the forefront over the course of the next few months, is the question of recession. Clearly we've started out this year better than expected from an activity standpoint. Some of that has to do with, the fact that Europe avoided a recession. Some of it has to do with the fact that China reopened. Some of it has to do with the fact that the labor market remains very tight. But we are beginning to see signals that some of those things are beginning to cool off and fade. The backup in initial jobless claims, the backup in the unemployment rate, anecdotally, consumers using their credit cards more, saving less. And so I think we're going to learn a lot about the growth story that, to the point that was just made, equity investors have very much been willing to look through. I think that's going to be the main focus during the second half.
So when you think about the potential for that recession, how much downside do you think investors should be looking at right now? Sure, that cloud has been lingering for some time, but it's been a question of how severe it's going to be when it comes.
So I think that the recession question and the market question are arguably two different ones. We do think that any recession, if it were to materialize today, would look relatively average. And that's not to say that we wouldn't feel it, that the unemployment rate wouldn't back up, that we wouldn't see a broader deterioration in the 6 variables that the NBER uses to evaluate whether or not a recession has occurred. But a lot of our clients seem to be suffering from recency bias and, focusing on 2008 or 2020 as kind of what they expect if we were to have a recession. And we think, again, it'll look more like what we've seen over the past 70 years on average, as opposed to what we've seen the past 2 times around. Now, the question around the market and what happens to equities as they begin to price in a slower growth or potentially recessionary environment, I don't think it's wildly out of touch to say that retesting the October and the June lows is in the cards if we see that deterioration in growth, and particularly if we see that deterioration in growth pass through into corporate profits. But we struggle to see material downside beyond that. So the bottom line is that it's going to be a volatile couple of months here as we get more clarity on exactly what any sort of economic downturn might look like. And again, we think that markets will begin to reflect that reality a bit more than they are today.
So Dave, that then leads to the question of how investors should be thinking about this just in terms of their positioning right now, because given the fact that tech was such an outperformer, so much of the gains really attributed to just over a handful of stocks, what does that mean then for some of the leadership maybe that's best positioned to withstand some of the volatility? So
from our vantage point, the key word for the second half and probably into 2024 as well is going to be optionality. We don't want to tether ourselves to anything that's too far out in the future. We don't want to make big bets on things that we can't, necessarily foresee with any sort of clarity. We like the idea of owning equities and bonds that return cash to us relatively quickly so that we can then take that cash and turn around and do something with it when the opportunity arises. I will say we came into the year with a view that tech was going to be a good place to be. That enthusiasm's faded because the Nasdaq's up 30% so far year to date. But if we were to see a pullback in those names, that would definitely be a place that we'd be looking to step in, because I do believe that these are not your father's tech stocks, right? They're more defensive than what we saw in the late 90s and the early 2000s. So leaning a little bit more into value today, shorter duration on the fixed income side, leaning more into growth and longer duration assets as we get more clarity and when those opportunities present themselves.
David, you could certainly argue that there's a little more of a value play, especially in the big tech names, but there has just been this incredible run-up that we have seen, all fueled by this excitement around artificial intelligence. I'm just curious how you view that. Is it sort of a mini bubble? Is it investors sort of grasping onto any optimism in the concern and in the broad context of the headwinds that are coming through on the macro side?
So I think longer term, I mean, artificial intelligence, it's going to change the way we all work and live. The question is, when is it going to change the way that we work and live? And I do think that investors may be a bit over their skis in the current environment, expecting these productivity gains to materialize effectively overnight, whereas we see the runway here as being a bit longer. And so it definitely will help boost growth longer term. But I think that investors, I wouldn't call it a mini bubble. I'd say what we're dealing with today is more FOMO, right? It's the fear of missing out. It's the idea that these are the companies that will lead us to the other side of the AI revolution. First of all, that's a really big bet to make. I'm sure some of them will be around, but perhaps not all of them, and at least not play the role that investors seem to be pricing in. And so I think investors need to be nimble and they need to be flexible. They don't need to bet the farm on a handful of names, thinking that that's going to be what gets us to a more productive AI-driven world. So long term, we view this as having significant potential. Short term, I'm viewing it with a bit of skepticism.
Well, David, one of the themes certainly of the first half of the year was inflation, where the U.S. stands. Well, if you take a look at what's happening overseas, the ECB President Christine Lagarde saying that the fight against inflation is not done, that inflation still remains too high. And the perspective that this is a global story, what do it mean for investors here in the U.S.? How are you seeing those developments overseas and the actions that we've seen from central banks around the world affecting traders here in the U.S.?
So I actually think that for the first time, well, we've seen it over the past 12 months, but prior to that, we hadn't really seen a synchronized tightening cycle in 15 or 20 years. And so I think that to an extent, people in the U.S., investors in the U.S., can take a cue from what's going on abroad. Not so much from the ECB, where they've been relatively clear and kind of stuck to what they've laid out, but more so from the Bank of England. I mean, the BOE came in and surprised with that 50 basis point hike the other week because inflation is not coming under control. And yes, headline inflation in the United States has come down nicely as a lot of the base effects from Russia's invasion of Ukraine have rolled out of the calculation. But core inflation, super core inflation, right, core services, ex housing, those numbers have been range bound for more than 6 months. And so squeezing that last little bit of water out of the inflation sponge, I do think is going to be more difficult than a lot of people expect. And what you're hearing from central banks in the US, in Europe, and in England is that the risk to interest rates remains to the upside. These guys are not done tightening because they don't want their legacy to be that they let inflation get away. And I would go as far to say that with respect to the Federal Reserve, they've already made one policy error, right? They started too late. They're not going to want to make two. And that's going to keep them acting conservative in the fight against inflation.
So, David, when you say the BOE is taking the lead, I mean, does that suggest that you think that the Fed should keep its foot on the pedal, that they shouldn't continue with this pause? Because there is the other side of the debate, which is to say, look, how long is that lag factor? And is there a risk in the Fed moving too quickly yet again when they haven't seen the full impact of their tightening so far?
So there's always risk in the lag factor, but the problem is nobody knows what the lag factor is. And so it becomes this game of speculation. And, again, interest rates are a very, very blunt tool for managing an economy. And what I think the Fed is kind of spooked by is what happened in the 1970s, where a very wishy-washy approach to monetary policy was taken. First Chairman Burns was tightening, then he was easing, then he was tightening, then he was easing. And because he couldn't stick to one approach, inflation ended up becoming a structural issue. I think that the Fed and other central banks recognize that mistake was made and they don't want to repeat it. And so to them, erring on the side of caution and potentially knocking the economy into recession, if it means solving the inflation problem, is far more palatable than taking their foot off the brake prematurely and allowing inflation to once again begin to rear its ugly head in a more significant way. And so I think, again, the risk to rates is to the upside. The Fed is not done. They've said they think they're going 2 more times this year. I think that needs to be the base expectation for every investor.
David, if the Fed isn't done yet, if we do see this another rate hike, at least one more before the end of the year, this risk of recession that you've been talking about, what does that mean then for the jobs market? Because the jobs picture has held up relatively well, very well, really, up until this point. Is that going to start to change? And I guess how material of a change do you think we'll see?
I think it is going to start to change. And I think that that's where the lag in terms of interest rate hikes and the impact on the economy is right now the big question, because the Fed's done a lot. And everybody's looking for the labor market to cool, but it's just not cooling the way people would expect. And so to me, the question around the Fed and more so what gets them to cut rates is really dependent on a broader deterioration in the employment situation. To put it differently, the unemployment rate needs to go up enough that the Fed begins to prioritize a dual mandate rather than singularly focusing on inflation. Once they begin to have a more balanced approach, I think that we can expect them to begin to ease policy, but not until the labor market deteriorates and everybody's waiting for that shoe to drop.
David Lebovitz, great to get your perspective here. JP Morgan Asset Management Market Insights Managing Director. Thanks for taking the time.
Thanks.
All right, well, markets have certainly enjoyed substantial gains so far this year. The S&P up more than 13%. But what does history show us when stocks are strong in the first half, and what could it mean for the rest of the year? Jared Blickery here with a closer look, putting it in historical context for us. Jared, what do you got?
Thank you, Shauna. This is to continue a conversation we started yesterday. I was looking at the Nasdaq performance year to date, up an impressive almost 30, let's call that 30%. You can see a few zigs and zags here. Let me put our line chart instead of bars so you can see. This is actually a good thing, because I was looking historically what happens when the Nasdaq is up big, just as you were talking about in the intro here. And guess what? Some of the best days, the two best years actually, which were 1975 and 1983, saw significant downturns. In fact, they gave back quite a bit of those earnings, of those returns for the first part of the year. Now, in 2023, we don't know what's going to happen, but I think investors would love to see what happened in 1999. That's when the Nasdaq was up over 20% in the first half and up over 40% in the second half. But I decided to filter and try to figure out why this exactly was, why some of the best years gave back those gains in the second half. Now here's the Nasdaq in 1986. This is a bar chart with a blue 10-day moving average, and you can see it's from the lower left to the upper right. This is the mid-year mark right here at the end of January or end of June. And you can see it hardly spends any time below this very low moving average, or that very low digit moving average. And that is just a sign that it's climbing the wall of worry, did not have any major pullbacks, did not have those, I guess, moments where investors have to question whether or not they really want to add more. And it's just kind of sucking investors in there. You can see what happened in the second half of 1986. Big decline, gave most of that back. Now you contrast this with 2019. Here we have the beginning of the year. We also have big gains throughout the first half of the year, but you can see we did have a bit of a correction here. And in the second half of the year, it was up and away again. So back to the original point here, when you filter out some of these other years where you have too good, I would say, price to perfection in terms of returns here, when you're climbing that wall of worry, when you're just going straight up without looking back, that's actually bad for the market. So we bring it back to the present. Where are we right now? As I said, we have actually given back some of those gains. We've had some decent pullbacks. So this argues that we could actually build on these gains. Doesn't necessarily have to be that way, but it does argue that we're not going to give back huge chunks here. And so I think when you consider all of this, and especially the fact that we have a little bit more volatility this year, that's actually helping us, and it actually helps the return outlook for the rest of the year. So something a little bit non-intuitive, but glad I was able to dig into that.
Yeah, a little bit optimistic here for the second half of the year, because I think a lot of people are pretty worried about where tech valuations are today, right, Jared? Thanks. Well, we are just getting started here on Yahoo Finance Live. Coming up, home prices increasing again in April, signaling a recovery in the housing market. We're breaking down the latest real estate realities. Plus, Lordstown Motors riding into the red as the EV maker files for Chapter 11 bankruptcy. What this means for the EV space later in the hour. And Costco is cracking down on its membership sharing. Could this have the same success that Netflix has had? That and much more when Yahoo Finance Live returns. Investors piling back into tech stocks today, coming on the heels of yesterday's move to the downside. While our next guest is warning not to be fooled by some of these recent moves. They certainly have been the outperformers so far this year. He's actually pointing to some other areas to focus on for future investments. Joining us now, we want to bring in David Wagner, portfolio manager at Aptus Capital Advisors. David, it's great to see you here. So you're coming with some picks that you see an opportunity with for the second half of the year. When it comes to some of the moves that we've seen in tech, you actually like two names outside of tech. Let's start with Visa, your first pick. Why do you like it? Why are they positioned well?
Yeah, I definitely think it's time more for the average stock to succeed and more some of what they're calling the Magnificent Seven, maybe just to take a little bit of break. But simply put, Shauna, I believe that the combination of double-digit revenue growth with mid-teen EPS growth and the stock traded at a historical discount on its multiple, well, that's going to check a lot of boxes for me here in this market. Though I do think that investors have been a little bit confused around Visa's recent stock performance. I think that really stems from the expectations that volumes are going to decline into the future. I mean, if you look at the Bank of America data coming out in May and April, it did point to some weakness on consumer spending, well, at least decelerated right now. So yeah, dollar volumes are definitely making people think that, Visa may not be a really exciting place to be right now. I mean, yes, it's already an overcrowded name, but I think that a lot of these problems are definitely getting discounted in the valuation right now. The stock trades at only a 30% premium to the S&P 500 when it tends to trade at a 50% premium right now. So, all told, I do think that the company's ability to protect on the bottom line in a variety of macro scenarios alongside a reasonable valuation is definitely a reason to remain invested in this name or add to a position.
Let's talk about the names you're trying to avoid, because there's a lot to parse through. These have been real favorites here, at least in the first half of the year. Two stocks you say you want to avoid are big tech. Google, let's start with that one because they've recently received two downgrades, the latest one coming from Bernstein. It's interesting to see these notes coming out talking about the concerns about AI on their search ad business, not necessarily their ability to compete on the technology of AI. How do you view that?
Yeah, Kiko, it's probably more of a tepid take here for me because I'm probably going to sound a little bullish on Google here right now because it's a wonderful stock to really own for the long term. If I had some type of portfolio where it was more of a set it and forget it, over the next 3 to 5 years, I would happily own Google in it. But I do think in the near term that there's going to be some short-term headwinds here, especially after the recent price movement. I mean, most of all, I do think the stock looks fairly valued as the narrative here has definitely caught up with the fundamentals. But yeah, that's definitely has allowed this company to, be up 40% since its market bottom back in November. But it does appear, as you just mentioned there, that, Google search market position is definitely under increasing threat from Microsoft. And then you have a potential, for some type of financial problems from integrating Baird into Google search. Basically, the company's risking creating some near-term air pockets on the revenue side by cannibalizing some, prime real estate for their generative AI results, which is definitely going to take away ad space from its buyers. But, I think it's kind of probably dangerous. There is some danger, I guess, it's probably the better way of saying it, moving to the sidelines on a name like Google because it screens really well. I mean, the company has a ton of cash. It's trading, like 20 times forward expectations. And the company still could see definitely a pathway to a 12% revenue growth CAGR actually over the next few years. But really from my seat, I think that the risks associated with this competition in search and then some potential margin misses definitely outweighs the potential upside actually from just some top line beats here.
David, another name that you're saying to avoid, NVIDIA, that's like up 185% since the start of the year. Why is this as good as it gets, at least for now?
Yeah, I probably trimmed this a little too early, but I actually still in this name. I love the name, long term, but I'm probably going to continue to collect some gains here. And I'm going to mention it's not solely because of that massive move you just mentioned there, Shauna, but really more it's just the injection in a portfolio from a price volatility standpoint, given that the stock is probably very highly valued in the eyes of many people. I mean, we all know that this is really just more of a narrative type of stock right now. And in the AI space, there's going to be winners and there's going to be losers because, it's a potentially very, very large market. So we know that there's probably going to be wild prices and valuations, some wild pricing just at the individual stock level. And that's probably what you're going to get here in NVIDIA, especially as I mentioned with its valuation. But I think it's also important for investors really to understand the bull case here. And that's definitely around Hopper. Because I do think that GPU will continue to drive positive earnings revisions into the future. Because what we've learned from past cycles is that data center cycles, they don't just last 1 year. So that last earnings report on their Q2 guidance probably isn't one time in nature. But the biggest reason, as I mentioned before there, Shauna, that I'm on the sidelines is that there's probably going to be some air pockets in this price, because that's a risk of buying a name at this valuation of what they're trading at right now. If there is an air pocket on some type of earnings guidance, which is probably inevitable at some type of point, you could see the stock pulling back 20%. But like I mentioned before, I own the name, I've trimmed the name, but that's really because I don't want to subject a lot of my investors to all that price volatility within a portfolio.
David, is that something that's specific to NVIDIA, though? Because we've seen a lot of choppiness in NVIDIA's competitors as well, especially given the enthusiasm around AI. Is it specifically the concern around these air pockets that you talked about with NVIDIA, or can you sort of put that thesis to some other names like an AMD and other chip makers?
Yeah, I think that's a blanket comment that can be tossed across a multitude of names. Look at Marvel, look at AMD, look at Avgo. If I were to play one there, Kiko, I probably would be playing more Broadcom right now, which I do own, more so because of the valuation. It's trading closer to 17, 18 times, while NVIDIA is trading actually at a lower than historical multiple at 46 times. It's still below like an AMD and a Marvel. So I believe that, people here over the last 10 years have believed that price presages price movements, when in fact, over longer periods of time, price doesn't always presage price movements. Its valuation is one of the best drivers to presage future outperformance.
All right, David, before we let you go, let's get to your last pick that you actually like right now. You think it's positioned well in the insurance family, Progressive. What is the edge that you see in Progressive against some of its competitors?
Yeah, Shauna, I really, really like Progressive right now. Probably a little too much, to be quite honest. But I believe that their positioning and profitability of Progressive really makes it a category killer. I mean, the company benefits from size. It benefits from scale. I mean, just look at the long-standing track record of its superior underwriting prowess. And then you also have a company that's experienced its fastest growth in about 21 years, which is aided by its dominant brand name and its multiple distribution channels. I think that the misunderstood part here, why it's only trading at 17 times, is that auto insurers pricing works on a 2-year lag. Go back 2-3 years. You had a substantial increase in used car pricings since COVID, but you had these higher loss ratios because these companies weren't compensated from an increase of premiums just yet because they had that 2-year lag. But now we're starting to see actually the exact opposite. You're starting to see used car pricing come down in a period where actually auto insurers are getting some type of tailwinds from rate increases. So just look what's going on in California in that case. But that's really increasing the revenue, and that's increasing profitability with a healthier combined ratio. I think the knock on PGR is probably the exact knock you're going to give on NVIDIA. It's going to be valuation. But I think here in this case, investors are miscategorizing the name because, yes, it's an insurer, it's a financial, but I don't see it as a financial at all. I actually see it as more of a consumer staple, in my opinion. And if you look at it versus consumer staple peers, whether you're going to throw out a Colgate, a P&G, a Pepsi, it actually trades closer to the lower end of its range, of its 2-year range, actually, by 2 standard deviations. So I would actually say this is more of a relative value here, especially if you're looking to become more defensive in your portfolio positioning without giving up some type of earnings power.
It certainly hasn't seen much move since the start of the year, up just over 1%. We'll see if the second half is better than the first. All right, David Wagner, portfolio manager at Aptus Capital Advisors. Thanks so much.
Cheers.
Well, Facebook parent company Meta is announcing a number of new safety features for teens using Messenger and Instagram. Yahoo Finance's Dan Halley has the details. Dan, this of course comes after a lot of criticism directed at the company for the influence some of these apps have had on younger users. To what extent do these address some of those concerns?
Yeah, it's kind of a mixed bag, right? Let's go over some of the announcements that Meta made today. They're announcing new features for Messenger. That's formerly Facebook Messenger. It's the messaging service that you can use through your Facebook account. They also announced some potential changes to Instagram and then some changes to Facebook Blue, the main Facebook app. For Messenger, there are now features where parents and guardians are able to see how much time teens spend on Messenger, see updates to their contact list and privacy settings, learn who can message their teen, and then check in on who can see their Messenger stories. They're also working on a way to limit who can direct message people on Instagram. Basically, people who try to connect with you on Instagram who you're not already connected with would only be able to send one invite and only text, no audio, no video, no nothing. And this is to prevent unwanted connections on that platform. They also have a way where if teens have an unwanted interaction on the platform, they'll be able to invite their parents to kind of supervise their account. Now, I don't know what teenager is going to say, hey, mom and dad, come over and look at my Instagram account. But it's an option, and some teens may end up going for it. And then finally, they're announcing a new feature that allows for teens to get a notification when they spend 20 minutes scrolling Facebook. They're also working on something that'll alert teens about scrolling through Instagram for a long period of time, Instagram Reels in particular, at night. So it's a number of new features, but the cumulative effect is going to be difficult to discern just because, look, you could talk about whether parents can look at accounts or not. Teens can set up their own account. It's simple to spoof your age on a platform like this. If you're 15, 16 years old and you don't want your parents looking at what you're doing on Instagram, you can set up an account and say that you're, I don't know, 24 or something like that. So it's not exactly difficult to do. As I said, the teens inviting their parents to monitor their account. Again, I don't know very many teens that are going to be willing to do that. I certainly wouldn't have when I was a teen. I think the 20 minutes on Facebook and the potential warning for Instagram, those are good ways of trying to police teens' usage of the apps. You just, even for myself, I end up just, scrolling and scrolling and scrolling. And for teens, it's a little bit more difficult for them to control the urge to just keep going. So it's a good step forward, but, will this kind of mean a overall better experience for teens on Instagram and Messenger and Facebook? I think that remains to be seen.
Yeah, Dan, what do you think the future is going to look like here for Meta? Because we know that it has, when it comes to teens and safety, because they have certainly been under a tremendous amount of pressure to do more to protect their younger viewers. But like you have been saying, there's lots of questions about whether or not features like this are even going to work. Are they trying to, I guess, address this in a more effective way? Or can they only go so far in policing some of their content?
Well, look, Facebook whistleblower Frances Haugen had basically pointed out these are, apps that are meant to be addictive to users, right? You're supposed to constantly want to scroll and stay online because that's how advertisers can then advertise to you. So it's the longer you're on, the more money they'll make. When it comes to the overall mental health influence, we had the Surgeon General of the U.S. issue an advisory about that. The Biden administration says they're starting a task force. Again, Frances Haugen, the whistleblower, had pointed out that Meta knew that Instagram was damaging to teen girls' mental health in particular, but continued to offer the service. So, then there's also a Wall Street Journal report that pointed to pedophile rings that were on Instagram and hashtags allowing them to kind of connect through recommendation systems. Meta, by the way, said that they are working to address that and have addressed that. They took down 27 networks in the past 2 years and removed hashtags that allowed that kind of conversation to happen, but something that the platform is still wrestling with. So I think this is a way for them to say, look, we're trying as best we can, but at least as far as the mental health aspect, the addictive nature of these apps, I mean, that's why they exist, right, is to get you to keep scrolling. I don't necessarily think a 20-minute notification is going to get kids to stop if it can't stop most people from scrolling.
Okay, we'll see how they all turn out. Dan Halley, thanks so much. Well, coming up, home prices grew for the third straight month in April. But does this mean a recovery in the housing market is imminent? More on the real estate reality when Yahoo Finance returns. Well, we got a fresh batch of data out on housing today. Home prices rose for the third straight month in April from March, but compared to a year ago, they posted their first year-over-year price decline in 11 years, while new home sales for May increased 12%. This all comes as higher mortgage rates have made home purchases more expensive for buyers, but potentially signal a sign of recovery in the market. For more on this, let's bring in Danielle Hale, Realtor.com chief economist. We just threw out a lot of numbers there, Danielle. Month on month, things look better. Does that point to a recovery?
I think it's too soon to say that we're in a housing recovery. We have been saying for quite some time that we think the sales low was in January. But I think today's price weakness is something that we're going to end up seeing for the next several months. In fact, just last week, we revised our housing forecast. We had been among the more bullish outlooks for this year for home prices, and we've taken our home price growth forecast and revised it. So we expect home prices to slip for the year, but less than 1%. So we don't think it's going to be a huge decline, but we do think some of the softness in home prices is going to stay with us. Buyers and sellers are trying to figure out what the right pricing level is in the wake of high mortgage rates, and that is a challenge compounded by the fact that we don't have a lot of home sales transactions right now. So it's going to be an interesting year in housing.
Danielle, when do you expect, you mentioned that further 1% decline in prices, when do you expect we'll see that bottom? Are we talking within the next couple of months ahead of the fall buying season?
So there are a couple of things going on in the housing market. So there's a strong seasonal pattern in the housing market. We tend to see the highest prices of the year in the summer and the lowest prices of the year in fall and winter. So that trend is happening. So even though prices are declining year over year, they're moving up. I expect that we will see the usual cooling off that we see in the fall, but the year over year price trends may continue to decline. So I think we'll see that weakness sort of stretch through the next couple years. And then we'll start to see home prices rebound more convincingly in 2024.
What are you seeing among buyers right now that are in the market? And to what extent have you seen them continue to stay on the sidelines because of inventory, because of higher mortgage rates?
Well, it's interesting. It's more sellers that seem to be staying on the sidelines. Buyers, on the other hand, seem to be quite active. And if you look at the existing home sales data that came out last week, it was pretty steady. It actually moved up a little bit. And if you look at the new home sales data that was out today, it surged for the month. So that is lending credence to the idea that if you build it, if it's for sale, buyers are interested. And I will say there is one piece of information from new home sales data that suggests that it's not that buyers are interested in everything. They're interested in affordable homes. And so if you look at the price distribution of homes that were sold in the new home sales data, you see an increasing share of homes were sold under the $300,000 price point. So buyers are out there and most interested in homes at that affordable price point.
Yeah, so Danielle, what does that tell us then about first-time home buyers? It sounds like maybe they're accounting for the majority here of some of the activity that we're seeing.
Well, I don't know that they're accounting for the majority because it is still a challenging market from an affordability perspective. But I do think first timers are getting some opportunities because the market is less competitive than it has been. And because a lot of existing homeowners who might be repeat buyers are choosing to stay put and hold on to their low mortgage rate. So that's opened the door for first time home buyers. It's still not necessarily easy, but there are some advantages that they have now that they haven't had in a while.
In terms of regions that we're seeing strength, the Southeast continued to be the strongest region. The West, where I am seeing the weakest activity, at least within the sector, the space. What's driving some of those gains, at least in the Southeast? Is it about sort of this migration that we keep hearing that has happened over time? And is it about the opportunities, the price points? What are you seeing there that leads to the strength?
Yeah, depending on the metric that you're looking at, whether it's sales or prices or market competitiveness, we generally see both the Southeast, the Northeast, and the Midwest performing well. Those are regions of the country where housing is much more affordable and where the labor market has shown some resilience. The one thing that is consistent across all of the different measures, no matter how you're looking at it, the West seems to be lagging behind from a price and transaction perspective. New home sales data today, for example, most regions were up. The Northeast up by double compared to last year, but the West actually a little bit behind where new home sales were in that region last year. So The employment situation in the West has not been as strong. We've not seen as much recovery. And the tech sector, which is heavily concentrated in the West, has also been a bit of a drag on the regional economy. And we're seeing that reflected in home prices and sales trends.
Danielle, what are you seeing in the rental market? I know you have new data out showing that renters are seeing some relief. How much relief are we seeing, and how big of a dip is this indicative that maybe a trend is going to start?
Yeah, so it was the first decline in our rental data since we've been tracking it, which goes all the way back to trend data goes back to 2020. It was a continuation of a slowdown in rent price growth. So we saw that start roughly in January of 2022, and that number has just gradually eased to the point of declining now in this first month of data in May. I think we're going to see some continued weakness in the rent side of things, on top of the fact that we've got some imbalance already. There's a record number of multifamily units that are under construction and that are expected to hit the market later this year into early next year. That's a lot of supply coming online. Great news for renters who have contended with high rents. Even though they're coming down, they're still very close to highs. But that is going to mean a more interesting landscape for landlords as they're trying to figure out how to price to make sure that they can maximize occupancy in the years ahead.
Yeah, welcome relief either way, even if it's just a slight decline. Danielle Held, Realtor.com chief economist. Good to talk to you today.
You too. Thanks.
The strength in new home sales helping drive shares of home builder stocks. Yahoo Finance's Danny Romero joining us now with more on that sector. And Danny, we certainly have seen home builder stocks become a favorite here among some investors.
Forget the tech rally. Home builder stocks are really the winner here. Confidence among home builders is really pushing the sector's index to hit a 52-week high today. The S&P Home Builder ETF is up 28% for the year and outperforming the S&P 500's index of a 12% gain. So a major win there. And this comes after a Wall Street veteran, Nicholas Colas, says that home builder stocks remain cheap to the market. Other analysts are also echoing the same similar sentiment there. For example, one Citigroup analyst says that the housing shortages could provide a multi-year tailwind for home builders. The enthusiasm among home builders is really being foreshadowed in the latest earnings call. For example, Toll Brothers is capitalizing on the housing shortage right now, the phenomenon, that's what they called it in the call just a few weeks ago. And to give you some perspective as well, inventory of single family homes is down 19% for both new and resale homes. And so there is a lot of enticement there. Obviously, we do need more homes now, so that it really showing in that shortage. But the final point here is that the market rally isn't just about tech. There are other sectors in the market that are really showing kind of a place for growth and that don't have that above average valuation, such as Lennar, Pulte Group, DR Horton. Those stocks definitely have an edge.
Yes, certainly home builders positioned well in the housing market. Right, Danny Romero, thanks. Well, coming up, we will switch gears and check in on the auto industry. Bankruptcy filings, layoffs, and supercharging networks have some car makers trending today. We've got that for you. Stick around. Lordstown Motors shares off just about 16% after filing for Chapter 11 bankruptcy protection. Now, this coming while the company also files or sues a chipmaker Foxconn. With more on what this means for the EV landscape, we want to bring Yahoo Finance's Josh Schaefer. And Josh, certainly this was foreshadowed. The company had warned just about the dire situation that they were in, but lots of questions just about what this means here for the EV landscape at large going forward.
Definitely questions for what it means for the EV landscape at large, and also just new IPOs that we've seen in the last couple of years, right? When you think about a lot of those companies were EV companies. And when you sort of expand that out and you think about the amount of IPOs that we had at the time that Lordstown came public via SPAC in 2020. There was over 300 about 300 IPOs that year. Then you had IPOs sort of peak in 2021. And really what you saw from Lordstown was that things just never fully materialized. You remember former President Donald Trump showcasing one of their trucks famously on the White House lawn, and that was probably the peak of Lordstown. That was certainly the peak of their stock. Shares were over $430 at that point and came precipitously down. You saw to about $2 right now. And I think it sort of gets to a larger point when you think about a company like Lordstown and companies right now and sort of what you do when your stock price is going down this much, right? Because you're a growth stage company, you probably need liquidity to keep driving up that revenue because you haven't turned a profit yet, but your stock's coming down significantly. So that puts you in a tough spot. Lordstown suing Foxconn because they're not getting the funding they thought they were getting. And you're gonna see more and more bankruptcies come as this happens, or maybe even M&A, right? Someone buying this company before they file for bankruptcy, because a lot of these companies are sort of in a tough liquidity position as that stock price drops.
Yeah, what exactly, I guess, are the next steps here for Lordstown, just in terms of some of the interest that they could potentially see, given the fact that, yes, they ran into those liquidity issues, which have been a problem now for quite some time, but they do have some technology that I think could be attractive here to some of the other players in this space.
They have a technology and potentially a plant, right, too, depending on what happens in court with Foxconn for who owns the plant that is in Lordstown, Ohio. So when we talk about bankruptcy, we're of course talking about assets, right? And that's going to be what's for sale. So the key thing is that endurance truck, the pickup truck that has been delivered in the US. So it's an EV truck that is certified and out in the US, which some companies can't say, right, in the electric vehicle space. So you would think there's value there. And again, you think there's value in the factory, potentially in the technology that's within the truck you're seeing right now on your screen. So it'll be interesting to see if they are able to sell part of that and how much that would go for. I'm sure it's going to be a far cry from that $5 billion valuation that we saw Lordstown have just 3 years ago. But there's still probably something there and something worth value in the long run.
Yeah, they hope so. Yeah, far cry from the $5 billion just a few years ago. All right, Josh, thanks.
Well, sticking with the EV space, today we've seen some winners and some losers. As Lordstown files for bankruptcy and Ford announces layoffs, Tesla, meanwhile, continues to win as Volvo joins its ever-growing network of superchargers following suit of major manufacturers. With more insight, let's bring in Greg Migliore, the editor-in-chief of Autoblog. Greg, let's start with the Lordstown story because, this is a pretty short run, even for a startup. Founded in 2018, filing for bankruptcy 5 years later. How much of this is specific to Lordstown? How much of this is a symptom of what's to come in the EV space?
Well, I think this is a really indicative of how startups can basically fare if they don't have the capital that's required to maintain the momentum. There's an old saying in the car business that you need billions, not millions. Lordstown barely had millions. They were trying to get that $170 million investment from Foxconn, and that was like lifeblood. $170 million is like change of the seat cushions for Ford or Tesla or Toyota. So they didn't have the capital that they needed to make a long-term go of it. So we'll see. I mean, I think there's a lot of startups out there that do have compelling products. They just need to have the business case. They need to have that customer niche to have that staying power. And as you can see, Lordstown didn't really have it at this point.
Greg, do you think Lordstown has some assets that some of the larger players within the space would be attracted to, would be interested in?
They have an electric truck that is fully formed. I've driven it. I'm one of the few people who have and maybe ever will. We'll see. It's a decent truck. It has a respectable electric range. It's capable. It's marketed at more of like a work segment. So they did have a defined plan. They just weren't really able to execute it. If you were looking to have like a turnkey operation with a factory, depending on how the potential litigation with Foxconn works out, it's all right there. Like if you walked in with, say, $1 billion or something, maybe you could, get this off the ground. and you wouldn't have to do the product development or some of the testing because Lordstown's already done that for you.
To what extent are we likely to see more consolidation in this space? I mean, Lordstown, sure, to Shauna's point, we have seen them raising the red flag for a while. No real surprises here, but what about some other names that, at least from an investor standpoint, haven't necessarily gotten sort of the support, and there's a lot of concerns around just liquidity?
Yeah, I mean, I think when you look at Lucid, Rivian, Fisker, these are all like newer companies that have, much less capital to work with than the traditional automakers. I think they're all companies that you're going to want to watch. You're going to see, potentially we could see some M&A there, which I think could make some sense. A lot of these companies, like Rivian has 2 products, Lucid has 1. It would make sense for perhaps an existing automaker to reach out and maybe augment their portfolio by perhaps snapping up one of them. I mean, that could be a good strategic play. So I think we are going to see in the next, as the decade rolls on, some consolidation, some mergers and acquisitions. I think some of these companies, just organically, will probably go the path of Lordstown as well.
Greg, what do you think this means, or does it mean anything just in terms of EV adoption? The fact that if you have a name like Lordstown, some of the other smaller players within the space struggling to survive, is it going to have any impact, do you think, on getting more EVs on the road?
In this case, I don't think you want to read too much into it. I think Lordstown was a fairly niche company. They had they were like a work truck company, if you will. So I think, are they a sign for what other, startups could happen to them? Potentially. But at the end of the day, Ford, General Motors, Tesla, Toyota, you name it, they're investing heavily in electric vehicles. And consumers are going to have a lot of choices out there. They're going to have a lot of different options, a lot of different dealerships. So they're going to have options. If you're a consumer, you're probably actually not thinking of a startup because many of them are actually expensive or sort of narrow use cases. I think the mainstream automakers and Tesla will have far more options going forward.
I mean, that raises the question, how much of this in terms of adoption is about the car itself? How much of it is about the range anxiety and having the infrastructure in place? There's a new study out that points to just where the adoption is happening. Some interesting numbers, though, here from iSeeCars.com pointing to Hawaii, Oregon, Vermont, Washington, and California seeing the lowest growth in EV growth, we should say. So California, take that as an example because we have seen massive adoption there. We're still talking just over 15%. Nationally, about 10% roughly, maybe a little under. I mean, is that kind of the tipping point? In other words, it's easy to get to maybe a 20%, but getting beyond that is an even bigger hurdle.
Yeah, I think that's fair to say. I think what we're looking at right now is the products are there, they exist. There's a lot of great EVs. I've driven many of them. Right now, the next part of the equation really is the infrastructure. How easy is it going to be to charge your EV? Where can you do it? What kind of plug will you be using? That's like the next great, unknown, if you will. And, you're seeing different companies are doing deals with Tesla now to get on the supercharger network and things like that make it easier for consumers. And that's really the next big part of the equation. It really is the network.
Is it about the fast chargers, though? Is that necessary as opposed to the level 2 chargers we see a lot of? Or does it need to be even more ubiquitous? Do we need to have something like wireless charging in order for drivers on the sidelines to feel comfortable switching over?
So, I mean, not to be a cop-out, but it's all of the above. I mean, it really has to be a situation where when you pull into like a charging station, it's accessible, it just works, and that it's quick. You really need to have whatever your EV may be. It has to be capable of fast charging, and most of the new ones are. And you need to be able to do that at whatever roadside, place you're going to. It's got to be basically like filling up your car with gas. And I think, are we going to get there in the next, 10 years? Maybe. I don't think it's going to necessarily be like a 2 or 3 year thing, just because there's so many challenges to getting above, like you said, that 10, 15, 20%. Like right now, there is enough infrastructure to service the people who are early adopters, who are really into electrics. But once you get beyond that, there's millions of people in this country, and you need to have a lot of options, and it all needs to work. And I think that's a really big challenge right now.
Yeah, range anxiety, lack of infrastructure, I think keeping a lot of people on the sidelines when it comes to EVs. All right, Greg Migliore, great to have you, editor-in-chief of Autoblog. Coming up, we are checking in on some of the biggest movers of the day as we get ready to count down the final minutes of trading. We'll be right back. All right, that closes out today's trading session. You're looking at gains across the board. Again, this is the last trading week of the first half of the year. The Dow closing up just about 210 points. S&P up about 1%. The Nasdaq, the outperformer of the day. A lot of the tech companies catching a bid here amongst investors. The Nasdaq closing up just over 1.5%. Let's take a look at some of the individual movers. On the flip side, we want to take a look at Walgreens sinking on earnings. We're looking at losses of just about 9%. The company lowering its guidance for the year, warning of weak consumer spending, especially as people spend less on COVID tests and vaccines. The worst performer here amongst the group of names today. You're looking at losses again, just about 9% for the year. Akiko, the stock off over 20%, certainly having a tough time catching a bid and really reversing the downward momentum that we've seen over the last several months.
Yeah, we are. And interesting that we're still talking about the steep drop off in COVID vaccines, given how many years in we are removed from the peak of COVID. But here's an interesting number here. Walgreens administered 800,000 COVID-19 vaccines in the quarter. That's an 83% drop year on year. And then testing volumes also down. Interesting to note one more thing that they did flag, which is student loan repayments. They're looking at that as another potential headline that could be coming in this quarter that could lead to a pullback in consumer spending. Well, Delta, another stock we are watching today, shares jumping after the airline raised its second quarter guidance. It's still benefiting from the pent-up demand for travel. Not just pent-up demand, though, Shauna. We are also seeing Delta, as well as many other airlines, getting a big boost from the pullback in jet fuel prices. Also, the trade-ups. We talk a lot about trade-downs. Delta talking about the trade-ups they're seeing from customers, whether it's paying extra money for extra legroom, a higher class. That premium number there for Delta certainly seeing some significant upside there. $19 billion this year.
Wow, 19 billion. Certainly, when you take in those two factors into account, that's going to help the company's bottom line. Also, just when it comes to some of this demand, though, that we're seeing, and Delta is not the only name here, but just the pent-up demand that we have seen for these airlines this summer is expected to be a record season. We're expected to see the numbers that we saw back in 2019, pre-pandemic. Delta was one of the names out there at Bastion saying that he expects it to be a record-setting next couple of months. Some of that robust demand that you're talking about international, a huge area of strength here for Delta. United had also mentioned the pent-up demand for people traveling overseas. So again, when it comes to some of this outlook, again, not largely unexpected here from the street, just given the fact that those demand numbers have been so strong now for several months. Let's also take a look at Meta shares getting a boost today thanks to a bullish note from Citi. Analyst Ron Josie raising his price target on the stock to $360 a share. That's the highest on the street. Citi saying that it's not because of the cost cutting, rather strength in advertising, specifically calling out the Reels platform here at Kiko ad revenue. They're expected that to jump 14% on a year-over-year basis. Reels to generate over $10 billion in revenue.
Yeah, he also highlighted some of the AI technology, the tools that was introduced by Meta, how he thinks that could help their ad revenue growth as well. Kind of interesting to contrast that with some of the notes we've gotten on Google about the concerns about how AI could impact their ad search revenue.
Yeah, certainly. Well, let's talk a little bit more about Google and what we're seeing more largely in some of these names that have outperformed since the start of the year. Google trading lower today over the past 2 days. We're looking at losses of just about 3%. Now, this comes on the heels of two downgrades. Bernstein cutting its rating on the tech giant to market perform, but it kept its price target at $125 a share. This is the first time that Bernstein analyst Mark Shmulik downgraded Alphabet since he started covering the stock in 2020. And yesterday, UBS downgraded Alphabet to neutral, still bumping its price target up, though, by $9 a share. Alphabet, not the only tech giant with some of those downgrades over the last couple of weeks. Let's discuss it, what this means for tech going forward. Paul Meeks, Independent Solutions Wealth Management Portfolio Manager. Paul, it's good to see you here. So certainly some, I guess, apprehension, some caution here from Wall Street, particularly from the sell side, from analysts saying that right now valuations look stretched in some cases. How are you looking at this from a portfolio manager and your allocation?
So if you run a tech model like I do, you essentially have to be fully invested at all times, even a year like last year when you're trying to find the dog with the fewest fleas. Luckily, we're riding the momentum this year, though I will tell you fundamentally, I'm a little bit worried, actually more than a little bit worried about valuations here. And I think this downgrade call, two different analysts each of the last 2 days on Alphabet is legit, even though I love the company long term, and I actually think it's going to be a nice AI beneficiary. But these stocks have come so far so fast. And I'll tell you two things. We just got through another round of quarterly conference calls. I listened to all of them. And NVIDIA, all the companies talked about AI, and some companies not even in the tech sector. But then afterwards, the Wall Street analysts that cover the companies didn't really upgrade their numbers, raise their numbers for any AI benefit. And so right now they're talking, but they're not doing. I would say that NVIDIA is an exception because after their conference call, analysts quickly raised the EPS estimate for this year and next fiscal year by 80% each. Nobody else had that bump. So I worry about the AI hype. I was around when we talked about .com in the late 90s, and I still have the lashes on my back from that beatdown when the bubble popped. The other thing I would tell you that's interesting is tech and aggressive growth stocks need low interest rates. And a month ago, we all thought that the Fed was going to potentially, at least this was in Fed funds futures contracts, lower interest rates by 2 times before Christmas. Then we get through June 14th, and the hawkish pause is now telling us there's about an 80% chance they're not going to lower rates 2 times before the end of this year. They're going to raise them 2 times. So that hawkish pause is actually a real incremental negative. That with the AI hype, those 2 factors scare me. And so, yeah, I really worry about the valuations of tech stocks here.
So what does that mean for your portfolio? Are you taking risk off the table?
What I'm doing is I'm still fully invested, but I'm trying to embrace AI with some stocks that haven't moved as fast just yet. And then I also try to play defense in other ways. But I think it's very difficult to try to time the market, go into wads of cash. And if you do that, because that was the right thing to do in 2022, and you don't reinvest, boy, you missed a huge move thus far in 2023. So to answer your question directly, within my stocks mix, try to play it a little bit more defensively than the other guy.
Well, Paul, then if you can give specific names, what are the best ways to play that with the defensive nature in mind, but also you don't want to totally miss out on some of this excitement that we're seeing in AI?
Yeah, so I own the regular cast of characters that everybody comes on the air and talks about. I just own them in maybe a smaller position size. I'll tell you the three stocks that I added in recent weeks to my Meeks text model. One is Extreme Networks. Now, Extreme Networks is not a household name, and so I'm playing some defense there because it's relatively cheap. I did buy some AMD, Advanced Micro Devices, to try to play, even though it's still fairly expensive. It's not NVIDIA expensive. And then I also added Uber, and I've been away from that company for years. And so these were three stocks. They've done well since I put them on my list, but I'm not just going after the same old like everybody else.
Well, what specifically you like about Uber?
I think Uber is interesting. Finally, a very visible path to profitability. So this year they'll be probably breakish even. Next year they'll earn at least $1. And so at long last, you're starting to see some powerful operating leverage. In the meantime, their key compare, Lyft, is a company that's badly damaged, in a hell of a lot of trouble. And so their comparison just got more favorable.
On the flip side, Paul, what are some of the names that you've recently dumped from your portfolio and why?
One of the things that I did is I've been very disappointed in the lack of the rebound post-COVID in China. So I had played, as we got into late 2022 into 23, back in to some of the important players in China, JD.com, Pinduoduo, Alibaba, and unfortunately, we're not seeing the consumer spending. We're not seeing the economic bounce. And as you've seen in recent days, we're not worried about economic strength. Now we're worried about economic weakness in China, and the Chinese central bank is lowering rates to support versus every other central bank around the globe raising rates.
Finally, Paul, a name we've been talking a lot about over the last month, Tesla. What's your view on that stock in light of what you have said about the run-up, the enthusiasm that has been surrounded around tech, the concerns around the debt load, especially with the higher rates? How do you assess Tesla?
I think Tesla's a bit worrisome. I've owned Tesla from time to time over the years, never in a big way. You never really can value it as an analyst should. It's more a cult, and a cult of one man. But I would tell you that I'm gratified that they've become the go-to for charging stations and EV infrastructure. But on the other hand, you have a hell of a lot of either emerging companies and probably more importantly, legacy car makers that are coming to the dance. And so that in conjunction with Tesla's stock price, I probably stay away. Not to say I won't go back. I have been in the stock, but it'd have to have a pretty deep drop for me to get reinterested in Tesla at this particular price.
Okay, always good to get your takes, Paul. Paul Meeks, Independent Solutions Wealth Management Portfolio Manager. Appreciate your time.
Thank you.
Well, coming up, June's consumer confidence report shows signs of life from investors, but does the growth need to persist in order to get consumers fully back on board? We'll discuss next.
The latest consumer confidence data bringing an end to the streak of net negative readings that we've seen from market expectations. Here to break it all down is Yahoo Finance's Josh Schaefer. And sounds like a bit of good news.
Yeah, Shauna, good news, and people are excited about it, right? So what we have here first is just the overall consumer confidence index. This is the broad index from the conference board, and you can see a little tick up recently, and it hit its highest level in over a year. That's the broad index. Now, what is interesting is consumers are also now more bullish on stocks. So when you take a look at how they feel about stocks, we had seen this big climb up. Bespoke Investment have been pointing this out for 17 straight months. More people had thought stocks would go down than go up. But that switched this week, or in the month of June, for the first time in, again, 17 months. And it's interesting to think about that in perspective of how long it took us to get here, when we've had a bull market now for over a month, and that rally's really been going on for most of the year. But it has come along with some data. So I want to take a look at housing data first and take a look at the Case-Shiller index. So you can see the Case-Shiller index also starting to pick back up. So what that shows us is housing prices are going up, right? Those actually beat expectations today, as did a lot of economic data, including that consumer confidence we just mentioned. Then you take a look at new home sales, which is interesting to think of when you think of prices are going up. Well, guess what? People are still buying houses too. That's important when you think about inflation, right? For prices to still go up and people to still be buying. A lot of economists are saying increasingly that that means inflation is going to stay high. So again, a lot of confidence right now when you think about this robust data. Then you take a look at the labor market, non-farm payrolls. Remember that May jobs report, we had that big $339,000 payroll reading. That was the highest we had had since January. So again, another strong data point. Interesting when you think about what that means for the Fed too, of course, about a 76% chance for a Fed rate hike per CME projections right now. And Sean, I think that's what I'm most interested in when we think about what this means. Positive readings, right? A lot of strong data. That also probably means more Fed rate hikes, maybe 2 more rate hikes. Do consumers still stay confident about markets when we see those rate hikes start to come into play, or do they start to get more negative on markets again, right?
Yeah, and what's been also interesting in the sentiment data has just been the swings that we've seen on a month-to-month basis. And a lot of that, I think, is driven by some of the rhetoric that we're getting from Fed officials, specifically what we're hearing from Powell in terms of the last press conference, the fact that he's saying that, hey, more rate hikes are going to be on the table. They do seem to be on the table right now if they do deem them necessary. So a bit of good news, I guess, in consumer confidence index this month in the overall reading, but whether or not that trend continues, a lot of that dependent on the next move.
And you've got an inflation print on Friday and then a jobs report next Friday, right? That could swing that sentiment and also what the Fed feels in just a few prints. So yeah, we'll keep watching the data.
All right, Josh, thank you.
Well, banks are gearing up for the results of the Fed's annual stress test. Those are due out tomorrow. This year's report comes just months after the banking crisis, when 3 banks failed. Let's bring in Jen Schomburger, who's here with a look at what to expect. What are we expecting, Jen?
Hey there, Kiko. You nailed it. That's right. The Federal Reserve due out with its annual stress test results Wednesday for the nation's largest banks. Those results largely expected to show that banks remain resilient in the aftermath of Silicon Valley Bank's failure, as well as other regional banks' failure. 23 banks will be tested this year by the Fed, only those with assets greater than $250 billion. A new law directed the Fed to change rules to test banks with assets between $100 to $250 billion every other year. That subset will be subject next year, a change some say helped lead to SVB's downfall, though 3 or 4 banks below $250 billion in assets have opted in this year, even though they weren't required to. We're going to learn which banks those are when the results are released. The Fed's stress tests were mandated annually by law after the financial crisis for banks with $100 billion or more in total assets. They examine how banks would perform during a hypothetical severe recession to prevent bank failures in a crisis. This year, the hypothetical scenario, tougher than last year, envisions a severe global recession with acute stress in commercial real estate. Under the Fed's scenario, unemployment spikes to 10%, home prices and commercial real estate prices drop by about 40%, and the stock market plunges about 45%. Banks will have to prove that they have enough capital on hand to meet or exceed the minimum requirements set by the Fed under this scenario. Banks can increase dividends and share buybacks so long as they don't fall below the minimums set by the Fed. We expect banks to release any updates to their dividend and share buyback plans about 3 to 4 days after the test results are released. Again, the Fed's stress test results expected tomorrow, Wednesday at 4:30 p.m. Eastern. Back to you.
Okay, we'll be looking out for that. Jennifer Schomburger, thanks so much. Well, coming up, Costco cracking down on membership sharing, and why it's Pepsi dropping its first ever condiment. We're diving into some of the top trending stories of the day on the other side. Stick around.
Prior to the weekend events, the Kremlin and Wagner Group worked collaboratively. The fact that the coup did not work, it's not entirely clear if Wagner will come back and fight with Russia. And then once you have something like this happen, people are questioning the staying power of Putin. So until people can be certain that Putin is the man in charge and is the person that they can talk to, the idea of a negotiated settlement with Russia is now just off the table.
I didn't see it coming. I have no idea what it means. What I do know is companies and lenders will not lend money to lose money. And with all the yield curves inverted, that ultimately should have some kind of impact on economic growth and therefore the markets.
Is Vladimir Putin's leadership falling apart? Just a mind-blowing series of developments in Russia, and many analysts think it's not close to being over yet.
I think the really interesting news that's really piquing, catching traders' attention is what's happening in Russia, and that's with the potential coup on Vladimir Putin. Now, I'm taking a look at the Wi-Fi Interactive. The price action since the open yesterday and Sunday evening, really not that volatile.
I was able to reach out to Andy Lippo of Lippo Oil Associates. If this does lead to a civil war, if this is the beginning of the end for Vladimir Putin, you could see a disruption when it comes to the oil coming out of Russia. Although there is a contrarian view, which is that if Vladimir Putin continues with his strategy, you could see more supply of oil coming into the market, and this would be bearish for the oil markets.
China's leader made a major mistake of his unlimited friendship with Mr. Putin. And what's that doing? Overall, to me, it's tilting the whole world towards recession. China's having a problem, and all the data is disappointing. That's the body in motion. You have to ask yourself what stops it. So I see crude oil is more likely to head towards 50, maybe even 40, based on what's already happened.
Welcome back to Yahoo Finance Live. It's time to talk about some of the top trending stories of the day. For that, we have Josh Schaefer and Brooke DePalma here to help us break it all down. All right, guys, let's start with one of my stories, and that's credit card debt. Not specifically the overall debt level here in the U.S., but more so how people view credit card debt. Now, some interesting things. This is from a recent study, a report out from NerdWallet. Right now, average American household has about just below $10,000 in credit card debt. But people are ashamed of the debt that they hold. About 2 out of 5, 40% of people saying that they aren't totally honest. 43% saying that it's okay if your partner doesn't know all about your credit card debt. Not exactly advice that I would give to people who are in a relationship.
Interesting, too, to see 39% of Americans say that they withhold it from their parents. You would think that your parents would be someone that maybe have gone through a similar situation, or at least have had to deal with some level of finance more than you at that point, and you would maybe lean on them. Right. I do get the part of people being uncomfortable about it. That totally makes sense. People don't really like talking about finances in general, right? That makes sense. Yeah. But you do kind of have to turn to someone, you would think. Yeah. So interesting to hide it from both your partner and your parents, who are probably the people you normally confide in.
But I think taking a step back, thinking of larger picture, the stigma that just surrounds credit card debt, people are ashamed of just how much debt. $10,000, to be honest, not that much of debt, certainly concerning, but at the same time, I mean, there are ways, there are opportunities to certainly fix that, alter that debt. I mean, I was reading some ways to avoid interest charges, pay your balances on time, establish and stick to a credit. In addition to that, auto payments are now out there, maybe buy now, pay later, but people certainly ashamed. I mean, we also noted that 1/3 of married Americans with card debt haven't told their spouse exactly what they owe. And so the stigma largely still holding on Americans' wallets here.
Yeah, they certainly are. And there was also a larger percentage than I ever would have guessed. I forget it off the top of my head, just how many people said that it's okay if you have a credit card that your spouse or your significant other doesn't even know about. That's not
concerning.
Necessarily, I don't think, the smartest step to take when it comes to how to handle financials, at least together. But Josh, you brought up an interesting point, and that's a number of people that are hiding their credit card debt from their parents. You would think that they'd be able to turn to them to help. On the flip side, so many parents are honest with their kids just about their financial situation. Almost, 3/4 of a percentage, so 75% of American people who have younger children are saying that they are totally honest. So you think that if you are one of those people who are suffering with a credit card debt, it would make a heck of a lot of sense to turn to people who have years of experience and how to best handle it.
I do like the being honest with your kids part too, right?
Yeah,
because it's helpful.
Transparency,
it's helpful to
learning,
teach.
exactly.
You don't learn it. You don't learn credit card debt in school. You don't even learn how to write a check in school.
Right.
So it's nice that people are actually doing that at home and giving that level of personal finance education that I don't think we really get in schools.
Yeah.
So it's good to see parents doing that part of it. It'd be nice for the kids to then maybe reciprocate it and ask the teacher a question or two, right, to make sure you're doing well in the homework.
Yeah.
But it's nice to see parents at least doing that.
And I think it's all just about having these conversations, starting them, which is so key, and starting them young. And maybe people don't feel comfortable talking to their parents about it because their parents never talked to them about it when they were younger. So starting that conversation as young as possible, I think, with your children is going to help maybe address some of these types of issues.
Right. And something else that Americans are doing are looking to save money at wholesale retailers. Costco, one of the ways that Americans are turning to save. Right now, Costco is actually cracking down. They're doing a Netflix-style crackdown here, ultimately making sure that the members do, in fact, are paying members. And so ultimately here, reports saying that shoppers are now getting checked for their photo ID along with their membership cards at self-checkouts. I mean, right now the baseline membership for Costco is $60. So many Americans are going there looking to save money during this time when inflation rates continue to remain. They cool down a bit recently, but not as much. And as you can see here, I mean, Costco bringing in lots of money in order for these paying members. And so perhaps maybe they should be cracking down like Netflix did.
69 million paying members.
Right, and brought in $1.04 billion in revenue year over year.
Yeah, so you wonder how many people are sharing platforms, right? I think broadly, it just makes me wonder how good they're going to get at this technology, all these different companies, right?
Right.
I know anecdotally the Netflix password sharing is working, right? There are plenty of people saying that. It might not be working at my household yet, but I'm waiting for it. But I think they're coming for my Netflix account, I'm aware. But what about when Amazon Prime starts doing it and all these subscriptions? How does that add up? And then who actually wins?
Right.
When I eventually do have to pay for everything, what don't I pay for? I think is the biggest
And when
question.
you're cross-comparing different membership opportunities, and they're all pretty similar in pricing, it's, will you slide and try to go somewhere else because maybe Costco's cracking down?
But I think Costco, though, is uniquely positioned given what you guys were just talking about, right? Because this is a membership that, yes, you will pay for, but a lot of times people pay for it because they save then when they do shop there. So this is money well spent. Whereas if you subscribe to 5, 6, 7 streaming services, that's probably not the smartest financial move. You have to figure out what exactly you are watching and prioritize it from there. But I do think this speaks to the fact that people are getting some subscription fatigue. They're reevaluating how much they are spending per month. This has come up time and time again. These topics becoming more popular because I think people are starting to pull back on their spending, figuring out what they're going to cut. In this instance, I think Costco is going to be okay.
Yeah.
No, I think so too.
That's
And also
people who go to
Sam's Club
Costco are
also
obsessed
doing
with
well.
Costco.
Exactly,
Obsessed with Costco.
right?
They're like
obsessed. The $150 hot dog combo, you can't miss it.
Anybody obsessed with pickleball?
Not
I'm obsessed
yet,
with
not
I'm
yet.
obsessed with the story. I'm obsessed with the story, right? So UBS was out with a note yesterday saying that they think that pickleball could cost Americans medical costs up to $500 million in 2023. That's a range of $250 to $500 million, essentially saying that the big part about this is that older people are playing pickleball. Who gets hurt more often in pickleball? Older people, so they're going to the hospital more. They're getting all sorts of injuries, and basically saying that the costs are going to pick up, and maybe there's an insurance play in here. I thought that was an interesting part of it when we talk about what it means for stock markets. But I mean, kind of just a crazy note too, Shauna.
It is a crazy note. It's a fun note. You never want to see people get hurt. That, of course, is not fun. But really just taking pickleball into a conversation that we haven't really thought about it, just in terms of what exactly this means for some of those insurers out there. The growth that they talked about in this note, and I know we've talked about the fact time and time again, pickleball, the fastest growing sport in America. They're expecting it to reach millions, but 150% jump in players to just over 22 million this year. My question, though, is how many people used to go out and play tennis, maybe used to play other sports where you could get a similar type of injury, and they're not spending as much time doing that now, and they're playing pickleball. So if you use that line of logic, then maybe that number isn't as significant in terms of what that upside cost could potentially be. But certainly it's an important thing to think about, and it's going to be interesting if we hear any of these insurers maybe start talking about it.
It's the same thing when you talk about more people going to the orthopedic, right? Because there was a break in that over COVID when you think about people weren't going for an ankle sprain.
Right.
They either weren't going outside, especially people that would be in an elderly home playing pickleball. They probably weren't going outside. There's a lot of restrictions. And then they also just weren't going for minor injuries. When you look at on your screen right now, you're talking about a wrist injury, knee, ankle. There are things that right there maybe you don't go to if you don't have to go, right? So I think that's part of the story too, is that people are just going back to orthopedics more. And so then you're getting insurance spending up with it.
Doing more physical activity, certainly. But also too, I think the question is here, is this just a fad? Is, pickleball going to go away, or is it here to stay?
It's fun sport.
Once it reaches, Wall Street research, which is like pretty granular, I don't know, maybe it's peak pickleball, but I would argue maybe people are having fun with it.
Yeah, and Brooke, you were an early adopter. Just for everyone in the audience, is very clear. You were an early adopter to pickleball. You've been talking about it for years longer than we all have.
I mean, when I was in middle school, they lowered the volleyball net, foot slid inside, might have gotten a concussion. We're over it. Don't know if I'll be trying pickleball anytime soon. But I know another thing that we did want to bring up, Ryan Seacrest, the new host of Wheel of Fortune.
Yes, Ryan Seacrest has been named the new host of Wheel of Fortune. Pat Sajak stepping down after 41 seasons. He announced that he is retiring, just about a month or two ago, I believe. Lots of questions about who is going to replace him. Ryan Seacrest, I'm not a loyal Wheel of Fortune watcher. Brooke, you are.
I am a loyal Wheel of Fortune
and you
watcher.
didn't think it was the best pick.
Ryan Seacrest, known to be a host, of course, but Dancing with the Stars, former host Tom Bergeron maybe would have been a great pick as well. I mean, Pat Sajak and Vanna White have just been such a dynamic duo now for more than 40 years. And I feel like Ryan Seacrest and Vanna White, the dynamic will be interesting to watch. Of course, many loyal fans thought maybe Vanna would be the new host. Maggie Sajak, his daughter, would be behind the puzzle. Bit of a plot twist here, bit of a plot twist.
I think the last time I watched Ryan Seacrest, he was hosting American Idol, and I want to say Doctry didn't win, but I wanted Doctry to win.
It's a while ago.
Yeah, so that's
last
about.
time you've watched Ryan Seacrest.
That's about my credibility.
God.
Yeah.
I mean, Ryan Seacrest now just.
Yeah.
He's a big name. I mean, he still hosts American
Needless
Idol.
to
If you
say,
didn't know that.
I don't watch Wheel of Fortune. He still hosts American Idol?
He still hosts American
I had
Idol,
no idea.
which is now
American
also
Idol,
on
I was
ABC.
going to say, or New Year's Eve, you don't watch any of the things. No, live with
Isn't it still
Kelly,
called Dick?
Ryan
Isn't it still
Seacrest?
called
It
Dick
is
Clark's?
still called Dick Clark's. Yeah, exactly. So it's kind of like now
Okay,
Ryan
so then I
Seacrest
have
is doing
seen that.
this.
I
What
You
is he
haven't
going
seen
to
Live
do
with
next?
Kelly, which you recently just left either? All right.
Yeah.
We'll get
Well,
you
it's a
caught
very
up.
popular game show.
Guess I gotta tune in.
I think it's good. I think it is a smart move. We'll see. But again, Ryan Seacrest, the new host of Wheel of Fortune. All right, Josh and Brooke, thanks so much. Well, coming up next, stick right here on Yahoo Finance. Airbnb recently making some changes to its fees. Well, it's actually resonating well with its customers. We'll tell you more on that when we come back.
Backlash to unexpected fees prompted Airbnb to roll out new features to increase pricing transparency last year. CEO Brian Chesky telling us at the time the changes were done to improve the user experience on the platform.
What we're asking hosts is to do reasonable tasks, not ask for anything unreasonable. We're setting new guidelines, and anything a host requests, we want to make sure that's upfront stated so you know what you're getting into before the booking. So I think the combination of showing an upfront price, showing better values up top, providing more discount tools for hosts to provide better deals, and more guidelines to provide more reasonable checkout tasks, hopefully people feel like this is an even more guest-friendly service to them.
Well, with the busy summer travel season now underway, Yahoo Finance contributor Vera Gibbons is taking a look at how those changes have resonated with customers. What's the verdict?
They are resonating well. I mean, the good thing about Airbnb is that they do take customer feedback very seriously and do make the changes on an as-needed basis. So a lot of people were complaining about the cleaning fees. They were going ahead and booking the properties that they thought were perfect for their family, idyllic setting. And then once they completed the booking, they were like, wait a minute, this total fee didn't include cleaning fees, and that put the budget, way out of whack. So they're going with greater transparency on that. And then the other problem that Airbnb users were complaining about was the list of chores that hosts were having them do prior to actually checking out. I mean, they were getting really extensive, and Airbnb users were feeling like the hosts were sort of double dipping because a lot of those chores were cleaning related, strip the bed, do the dishes, take the garbage out. So they complained, Airbnb listened, and the changes that went into effect recently over the course of the summer, or they're rolling out now, have been resonating quite well with consumers.
Yeah, I mean, Brian Chesky's saying that, look, it's reasonable to ask hosts, or for hosts to ask guests to throw out the trash, not to strip the sheets and wash them before you leave. When you compare it to hotels, though, how does the price point work out? Now that there's a little more transparency, what are you finding right now in terms of that comparison, and whether travelers are still sticking to Airbnb?
Travelers are still sticking to Airbnb. A lot of people like it, particularly families, because you can cook, you can grill, you save money on, dining out, do everything right in the comforts of your home. You get the amenities. For short-term stays, Airbnb does provide a better value than going the hotel route. And the short-term stays is really where the growth is. That has been the case for some time now. The short-term stays really sort of heated up over the course of the pandemic, and that's continuing to gain momentum into summer 2023. Now, it is going to be a very busy summer. Demand is ridiculous, both domestic travel and international travel. It's going to be an expensive summer for travel, no matter how you slice it. I mean, you can't get around that. And it's going to be packed wherever you actually go. But the good news now is when you're searching on Airbnb, you will see the total price up front. That's the whole transparency thing that they're talking about. You are going to see a more reasonable list of checkout chores. That's the other thing they were really, dead set on setting the record straight on that one. So it is going to be an all-around better experience, but it is going to be expensive to travel this summer because the demand is just ridiculous. I mean, it's through the roof.
Yeah, I mean, full disclosure, I'm certainly one of those travelers that I can't remember the last time I stayed at a hotel because I always do book on Airbnb because of that very experience you talked about. From a value standpoint, though, which one offers more value? Is it the hotel stay or is it Airbnb?
It's still Airbnb from a value standpoint. I ran that question by a couple of experts, and they all sort of agreed and said, you're still getting better value with Airbnb despite the fact that the fees are up. And in some of those uber hot markets where, Nantucket, the Cape, the Hamptons, those cleaning fees could be, 50, 60% of the total stay. So they do add up and they're not going away. But in those hot markets, you will just have to pay through the nose. But regardless, factor in everything else, it's still the better value than going the hotel route.
Okay, you got us all thinking about the summer plans or summer vacation. Vera Gibbons, as always, thanks so much for that.
Thank you.
Well, women remain dramatically underrepresented in corporate leadership roles. Recent data from McKinsey found that women held just 25% of C-suite positions, despite accounting for nearly half of the U.S. workforce. I spoke with KPMG U.S. Deputy Chair and COO Laura Nowinski at the firm's Women's Leadership Summit last week and asked her what companies can do to get more women into executive positions.
The goal, as you just said, of the Women's Leadership Summit that we hold here during Championship Week for the PGA Championship is really all about creating opportunities, frankly, for women in the game of golf and for women in business. And we concentrate on both this week. And our summit today is all about planting seeds, harvesting some seeds, and doing some networking, creating cohorts of women who can support each other on that journey to a successful climb through more responsibility into the C-suites of their companies. And the how that we do this is really it takes a village, right? It takes people who are mentors and sponsors. It takes networks of peers who are supporting each other with how did you do it? How can I do it? What are some of the ways we need to be really intentional about taking next steps? And it takes, frankly, women investing in themselves. And that's a little bit of what today is about as well, is giving women a time to pause, step back, reflect, make a plan, think hard about their future, and then invest in it.
And talking about positioning themselves for the future, making sure that their needs are met, KPMG out with a new survey taking a look at the mental health of women in leadership positions, what women are feeling like in the workplace today. And one of the statistics that jumped out to me right away is that 90% of women are more stressed at work than they were pre-pandemic. What do you attribute this to?
Yeah, well, we know that there is a mental health crisis going on in our country today, and the stresses of life, the stresses of change and the pace of change that's going on for people, the stresses of managing and I'll get to that in just a second, but people who manage other people and the multiplicity of all of these issues as you come to take on your team's stresses is really creating a challenging environment for all executives, but for executive women especially. And I think it's notable that women have been found to kind of lean on capabilities unique for men in their rise to executive positions, capabilities that include effective listening, capabilities that include being empathetic, and leading through service. And that these kinds of attributes that executive women disproportionately have are exactly the same attributes that consume all of the stresses of the teams that they're leading as those teams are themselves encountering mental and life challenges. So the pandemic certainly caused a lot of it. I know that stresses, multiplied during the pandemic, and I think that executive women leaders are disproportionately bearing some of the outcomes of that.
How can companies better support these women who are in this position?
Yeah. So I think executive leaders are getting support from companies because companies like KPMG are recognizing that life's stresses are often brought to work, that employers have a special place in responding to the tools, the resources that people need in order to start to manage their own mental health and their well-being better. So executive women can, really have their companies respond in ways that include employee assistance programs, include training for managers of people to recognize and bring awareness to mental health challenges in the workplace, to have the conversation not be behind closed doors, but out in the open. When you break an arm at work, you break an arm, you come to work with a cast on and everybody knows, right? When you're needing help with a mental health challenge, it should not be something that you have to hide from, but something that you can bring with you.
Laura, there's lots of buzz around generative AI, how it's going to disrupt industries, disrupt jobs. How do you think employers, managers can use generative AI to address some of these mental health concerns?
Yeah, I think there's two aspects to that. There's what kind of stress is Gen AI and technology change creating, and then how can we use Gen AI and all of the capability that's coming to help alleviate stress in the workplace? And both of those are important to recognize. I think that in terms of creating stress, pace of change, new technology, not only changing work, but changing life, and changing it at a pace that folks weren't even talking about this 6, 7, 8 months ago, and now here it is front and center kind of every day. We're talking about it. But the way that I think data and analytics, generative AI, natural language, artificial intelligence is going to enhance people's experience with their work world can really start to alleviate stress, as you said. How can we find a path to that? I really believe it's through not doing to employees, but allowing employees to really experiment, to innovate, to provide a base of training about the how and the why in the capability of using generative AI in their work every day. And I really think that employees will be finding ways to relieve their own spiky demands at work through the use of new technologies, including generative AI.
And Laura, when it comes to mental health, there has been lots of talk just about the return to office, what that looks like. Certainly some employees have been pushing back. They want that flexibility to work from home. How are you navigating this as a business leader in terms of whether or not you're bringing your employees back to the office, and how, if they are still working from home, you create that culture that's so necessary for a business to succeed?
Yeah. It is really important. There's been a lot of movement, and I think it's another thing, again, when it comes to stresses created by change. I don't think we're in a final landing place with respect to physical workplaces. And yet, I think employers like KPMG, and we are very proud of our response to our people in this, is that flexibility in where you work, but with purpose about where you're working and why, and is critically important. And so we have both been working on our people as well as our managers and having not one-way conversations, i.e. mandates, but two-way conversations, i.e. this is what we think our business needs, this is what we're hearing you, our employees, need. Let's dialogue and come to a landing place for now, but anticipating that there's likely going to be change. We might move back to more virtual work in certain areas. We might pull into more in-person work as our clients start to look for us physically to be with them more. So I think flexibility all the way around is key, and clarity of expectations, but those expectations not, again, being necessarily in-person or remote work mandates, but flexibility being, let's think about why we're together, why we might need to be together, or why we might need to work alone for periods of time. And we're people business. So we know that we need to create a human connection, and we know that we need some time together to do that.
And speaking of that flexibility, we know it's been survey after survey just in terms of the fact that women in particular really depend and want that flexibility when it comes to their work-life balance, given the fact that they do typically still take on the majority of household duties. How big of a catalyst do you see that flexibility that you were just talking about, being to getting more women eventually to those C-suite positions?
Yeah, I think it's absolutely critical, because we can create career journeys that have unbelievable experiences for women on their way to the C-suite, but do it in a way that also allows room to be in the other roles that women are often in, roles of caregiver, roles of household manager, and so it's really important to be able to blend now today. A job that has flexibility doesn't mean a job without demanding experiences. A job today with flexibility can have all of the demanding experiences that women who are rising to the C-suite need, and can provide flexibility. COVID did not give us gifts. It was a horrible tragedy, but this was a gift from COVID that added to this tool set of how do we get the right experiences and maintain a flexibility that we need as women, and to rise and still be executive women in our firms and our businesses.
Our thanks to Laura Nowinski, KPMG's U.S. Deputy Chair and COO. Well, coming up, it's closing time here in Yahoo Finance. But before we go, we will get you up to speed on the top stories of the day and the biggest movers. Stay tuned.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories today. Lordstown Motors filing for bankruptcy protection and suing Taiwanese manufacturer Foxconn. The filing coming after talks for a $170 million investment from Foxconn fell through. Lordstown is now alleging in its lawsuit that the company breached the deal. Lordstown is seeking a buyer for its assets. The electric vehicle maker went public via SPAC in 2020. At one point, it was valued at $5 billion.
Shares of Walgreens sinking on earnings, the company lowering its guidance for the year, warning of weak consumer spending, especially as people spend less on COVID tests and vaccines. Walgreens will also take measures to cut costs, including organizational restructuring and investing in automated fulfillment centers.
And one mover to the upside today, Unity Software. The gaming tool maker jumped on an announcement. It is launching a marketplace for artificial intelligence software. Corporate customers will be able to choose software that can help create game dialogue or graphics using AI. In addition, Wells Fargo initiated coverage on the stock with an overweight rating, with the analysts saying the company has the opportunity to expand outside of gaming.
Well, that does it for us today on Yahoo Finance. Be sure to come back tomorrow, 3 p.m. Eastern Time. We've got all your coverage leading up to and after the closing bell. We'll see you then.